Joining us here at Post 9 is Johnny Fine, head of the investment grade syndicate at Goldman Sachs, who we turn to for all things credit. Good to see you.
Good to see you too. Thank you for having me on.
Do you agree with this reaction, a big rush into bonds on the back of Fed Chair Powell and ECB President Lagarde and Bank of England's Andrew Bailey, all saying we're still fighting inflation?
So I think I do. I think, yes, of course, they are still fighting inflation, but I think we've seen the clearest signs ever that they're winning the battle, and the battle is almost won, and we're very, very close to being at the end of the hiking cycle. I think people are looking forward as to what that might mean in terms of growth prospects, inflation coming down, future cuts in interest rates to maybe stimulate more growth. I think that's helped to drive a lot of the flow dynamic that Jeffrey was talking about and a lot of the support that we've seen in the bond market more generally.
What do these bond yields, 3.4 on the 10-year, the 2-year comes down, way down. What do they tell you about where the market expects growth to be?
So I think it's certainly expecting lower growth as we progress throughout the year. As you know, the market expects Fed funds rates to be lower at the end of the year than they are today. So that's either no more hikes and one cut, or more hikes and multiple cuts. So I think that tells you that...
Even though the Fed says no cuts this year.
Even though the Fed says no cuts this year, it's been very, very, I think, strict about saying that multiple times in the last several months. Yeah. The market continues to not believe it. And I think really simply it's just that the market's saying that, yeah, sure, there's some risk that we've maybe over-tightened. We might need to put some stimulus back in at some point.
The same message came from the ECB, and the market took the same sort of undertone. The German yield really plunged today on the back of some comments from Europe. So you think we're past the peak tightening, and what? We've got a few more, like one more hike, two more hikes to go?
Market's pricing in one more hike. Jan Hatzius and his team are pricing in two. I never like to disagree with Jan. I'd probably say my bias is probably that we only see one more. And then we're going to be, I think, unchanged for the remainder of the year. So I think the market is pricing in, I think, too much release later on in the year. I think we'll stay stable at elevated yields.
What's all this meant for corporations? Because you see all the deal flow. Yeah. On the bond side.
It's been busy. And I think it's primarily been busy because of the shape of the yield curve. We're so inverted right now between 6 months and 10 years, around 140 basis points, that it's creating a real incentive that if you're a corporate treasurer and you're sitting there looking at markets and opportunities today, if you have any financing that you're looking to do in the next 6 to 12 months, you have a real incentive to go and do it today. Typically, financing early is like taking out an insurance policy, which you have to pay a premium for. Today, you're actually being paid to go and do that same trade. And that's generating a lot of activity. I'm expecting February to be very busy in the investment-grade financing markets.
And what kind of yields? Like, what kind of deals are you seeing?
It's really across the spectrum. We've seen a lot of financial issuance already this year. Now we're coming through corporate earnings. I think we're going to see issuance from all of the main sectors that make up corporate America. I think it's going to be, as said, very active over the course of February.
So ultimately, do you see more support for stock prices here as well? Everything you're saying sort of jibes with a better equity environment.
So I'd say that I would generally be of the view that the worst is clearly behind us. I think the market's pricing a soft to no landing. And I think I agree with that. I think that's the right base case. But at the same time, I think it's probably right, and you see this in terms of the financing activity taking place. Corporations are taking some chips off the table. They're buying insurance when they're being paid to take that insurance. And I think that'll be a driver of financing flows, and I think it'll be a fixture in the credit market in the coming weeks and months.
So what would you tell investors at home that do this through ETFs or looking for some opportunity where, 60-40 didn't work last year, but this year bonds are working in a big way? Well,
we've seen the return of yield. We've seen the return of opportunities to invest in safe yield at a reasonable return. We don't have negative yielding government debt anymore. We don't have negative yielding corporate debt, which we had $1 trillion or so of during peak QE. And so that's clearly attracting fund flows in. We've seen robust flows each of the last 3 weeks. I think today was a very, very small outflow. I would expect fixed income as an asset class, both in investment grade and in high yield, to continue to want to attract capital in as investment capital into our markets.
That's healthy. That's a healthy sign.
I hope so.
Right. Yeah. Okay. You're always optimistic, Johnny. Thank you very much. It's good to get the color. Johnny Fine from Goldman Sachs.